Ray Dalio, a highly regarded macroeconomic investor, believes that the United States is currently at a critical inflection point with regards to its ongoing debt crisis. He recently discussed this topic in an interview with Sam B.C, and his insights have gone viral on the internet. In this video, we will explore why Dalio is raising the alarm about the U.S. economy and what actions need to be taken. Dalio's concerns about the debt crisis stem from his analysis of the numbers. He predicts that the U.S. economy is nearing an inflection point, where the debt snowball could gain significant momentum unless drastic measures are implemented. He does not expect interest rates to decrease significantly in the near future. To understand Dalio's viewpoint, it is essential to grasp how investors consider bond yields. According to Dalio, bond yields should reflect the expected inflation rate over a specific period. Currently, the expected inflation rate is estimated to be around 3 to 3.5%. Additionally, there needs to be a real interest rate above the inflation rate. Investors who hold debt assets should receive a return that surpasses inflation by about 1.5 to 2%. Consequently, interest rates are likely to be around 4.5 to 5%. As we observe the market, we can see movements that align with these levels. When investors purchase government bonds, they analyze the yields using two components. The first component is the real interest rate, which represents the interest rate adjusted for inflation. The second component is the expected inflation rate. By assessing these two factors, investors can determine whether the bond yields are attractive and align with their investment strategies. Dalio's concern about the U.S. debt crisis arises from the increasing levels of government debt. If the interest rates rise and exceed the expected returns investors receive from holding government bonds, they may shift their investments to other opportunities. This could result in significant economic consequences for the United States, such as higher borrowing costs and a potential debt crisis. To tackle this issue, Dalio suggests taking prompt action. A proactive approach would involve a combination of fiscal and monetary policies that balance the need for economic growth with the aim of reducing debt levels. Finding a middle ground is crucial to avoid worsening the debt crisis while also encouraging economic development. One important aspect to consider when investing in bonds is the likely inflation rate in the future and the real return one can expect. Let's break it down. If you purchase a bond at a 3% interest rate and inflation is also at 3%, your real return would be 0. On the other hand, if inflation is 1%, your real return would be 2%. Conversely, if inflation rises to 5%, your real return would become negative 2%. This demonstrates the inverse relationship between inflation and real returns. According to Ray Dalio, there is a general consensus that inflation is likely to hover around 3% in the foreseeable future. As a result, investors factor in a real return of around 1.5%, resulting in bond coupon rates of approximately 4.5%. The key point to grasp here is that bonds only become attractive when they offer returns higher than anticipated inflation rates. Currently, the inflation rate in the U.S. stands at around 3.2%. Therefore, if the government wishes to sell its bonds successfully, it must offer coupon rates higher than this figure. Otherwise, potential buyers would not find them appealing. This leads us to Ray's next concern: the supply and demand dynamics of the bond market. The government issues bonds equivalent to the size of its deficit. Given that the U.S. runs a deficit, it needs to sell a significant number of government bonds to investors. The widening gap between spending and income necessitates the sale of a considerable number of bonds. However, Ray warns that the buyers for these bonds may be dwindling. This is problematic because the U.S. needs to sell an unprecedented amount of bonds now and in the future. The question arises, who are the buyers of these bonds, and do they possess the necessary appetite to meet the demand? This presents a substantial risk, as many bondholders have already experienced losses. This includes banks, central banks, and Japanese investors, among others. Consequently, there is an inherent supply and demand issue surrounding the bond market, with fluctuations expected. However, these factors constitute the underlying fundamentals that will shape it. Ray's primary concern is that, ultimately, the U.S. must sell a significant volume of bonds. Unless immediate action is taken to address the deficit, the government cannot avoid this necessity. The U.S. economy has reached a critical turning point, known as an inflection point, according to renowned investor Ray Dalio. This shift is primarily driven by a decline in demand for U.S. Treasury bonds, which poses a significant problem for the U.S. government. Previously, major buyers of U.S. Treasury bonds, such as Japan, China, and the UK, were heavily invested in these instruments. However, their patience has been tested due to the mismanagement of U.S. debt and the erosion of their Treasury bond portfolios in recent years. The Federal Reserve, too, has ceased buying U.S. Treasury bonds, further exacerbating the situation. As a result, there is concern that the interest rates on these bonds, reflected in bond coupons, will need to remain high for an extended period to entice buyers. This raises another issue: the increased debt burden on the U.S. government with higher interest rates. Ultimately, this will drain more resources from the government's coffers. This confluence of factors indicates that the U.S. economy is approaching a critical inflection point. The problem lies in the unsustainable accumulation of debt, which surpasses income growth. To address this, real interest rates need to rise to ensure creditors receive adequate returns. However, higher interest rates adversely affect the general population, burdening them with larger mortgage payments and creating financial stress. One noticeable aspect of the current economy is the government's distribution of stimulus checks and financial aid to individuals and businesses. While this supported the household sector, it also deepened government debt intentionally. Consequently, as time goes on, the savings decrease, and debt obligations gradually increase, leading to financial strain. The U.S. government initially sold bonds, while the Federal Reserve printed more money to purchase them. However, when the debt becomes due, the government does not repay it directly. Instead, they issue new treasuries to gather funds to settle previous obligations. The issue arises when this massive debt starts to roll over in an environment of high interest rates. The government has to refinance this debt and commit to substantially higher interest payments. Therefore, we are fast approaching the inflection point where debt obligations can rapidly accumulate and become unmanageable. This snowball effect presents a significant risk to the U.S. economy. In the current state of the U.S. economy, the deficit continues to worsen, forcing the government to print even more bonds at higher interest rates. This means that the interest payments on these debts become a much larger burden, which is often addressed by the government selling more bonds to raise money and cover the interest costs. However, this creates a dilemma. Who will be willing to buy these bonds? To entice buyers, the government must increase the interest rates on the bonds, which in turn leads to a debt snowball effect. Essentially, the government finds itself in a situation where it is borrowing money to pay off its debt, similar to how individuals may borrow money to make their monthly mortgage payments. As debt grows faster than income, debt service begins to encroach on spending. This applies to both the government and individuals. In order to maintain current spending levels, the government must continually take on more debt. This process accelerates, creating a supply-demand problem. When individuals face higher mortgage payments, they typically reduce their spending. However, the government struggles to do the same. Instead, they choose to go further into debt and raise money to meet the increasing costs. This sets off the debt snowball effect, leading to difficulties in finding buyers for the increasing amount of debt without needing to offer even higher interest rates to entice bond sales. Foreign demand for U.S. Treasury bonds, which account for about 40% of the national debt, is also impacted by internal political and social conflicts. These challenges pose a significant problem for the United States. The country does have a potential solution, as highlighted by Ray Dalio, which is to fix the deficit by earning more and spending less. However, implementing such changes on a national level is complicated. Increasing revenue typically involves raising taxes, while reducing spending requires cutbacks in areas such as healthcare, social security, infrastructure, and military expenditures. The government has continuously avoided making tough decisions regarding spending cuts or tax increases due to the unpopularity of these measures. However, this strategy only perpetuates the problem without offering a real solution. The U.S. has pushed its debt situation to such an extreme that a debt crisis leading to the country's bankruptcy is becoming a real possibility. This has resulted in a decrease in demand for U.S. debt from foreign countries as they see the government's negligence and lack of action to address the growing debt. To resolve this issue, Dalio suggests focusing on the strength of the country's economy. He emphasizes the need for the U.S. to have a good income statement by earning more than it spends. This requires increasing revenue and reducing expenses to achieve profitability. Additionally, improving the country's balance sheet by having more assets than liabilities is crucial. The current deteriorating financial situation poses a long-term problem that needs to be addressed urgently. Dalio acknowledges that solving this economic problem is a complex task. However, it boils down to improving the country's income statement and subsequently tackling the balance sheet. By generating cash flow, the U.S. can pay off its debts and lower its overall debt burden. This process will require significant effort and dedication, but it is essential for the long-term stability of the economy. In conclusion, Ray Dalio sheds light on the challenges facing the U.S. economy due to its growing national debt. The government's reluctance to take decisive action has resulted in a decrease in demand for U.S. debt. To overcome this issue, Dalio suggests focusing on strengthening the income statement by increasing revenue and reducing expenses, followed by improvements in the balance sheet by paying off debts. While this is a significant economic problem, addressing it is crucial for the nation's future stability and prosperity.